Hello everyone and welcome to Singularity One-on-One. Singularity One-on-One is a podcast feature of Singularity weblog where you can go and listen to it or download it in full. As you may already know, my name is Nicola, aka Socrates, and as always, I will be the man with the questions. Today, I am very privileged to have Spencer Greenberg as my guest on the show. Spencer is the Chief Executive Officer of Rebellion Research, the quantitative hedge fund that he co-founded in 2005 at the age of 22. So, hi Spencer, and welcome to Singularity One-on-One.
Hi, how are you?
Fantastic. I am very happy to have you here today. Let's jump right into the biggest reason here and not keep our listeners and viewers on their toes. Tell us, Spencer, what is so special about your hedge fund?
Well, Rebellion is unique because what we do is we take artificial intelligence and we apply it to stock market investing. In particular, we use a type of artificial intelligence that's known as machine learning.
That's very interesting. So let's go step by step here. First of all, you were 22 when you started the fund. How many years ago was that?
Well, we co-founded the company in about 2005, and we began trading in January 2007.
I see. So you've been around for about 4 years now. And in your experience, how is investing directed by artificial intelligence different than normal kind of investing?
Well, one thing about systems that are driven by artificial intelligence is that the systems can actually learn and change over time on their own.
Very interesting. And I know that due to some SEC regulations, you can only reply in a limited way to some of my questions. But can you elaborate a little bit more about the generalities, if not the specifics, about your fund?
Sure. So the basic principle is that we apply, as I mentioned, something known as machine learning. Mm-hmm. So that's a type of artificial intelligence that's getting computer software to learn automatically from data and then be able to make predictions from that data. And we apply that to over a decade of financial information. Basically, we have our learning algorithm analyze information about companies and then predict which companies are going to perform well and then actually trade based on that.
Okay, so let me take you here step by step. First of all, what is artificial intelligence in the investment sense, and you've mentioned the term machine learning. Perhaps you should make the distinction between machine learning and artificial intelligence for the benefit of our audience here.
Sure. So artificial intelligence is basically the study of how do you get intelligent behavior from a computer program. So that could be anything from playing chess to translating between different languages, or maybe face recognition tasks where you want to identify a face in a photograph. But machine learning is more specific than that. It's about getting a computer to learn automatically. So we can draw a sort of distinction between what you might call like classic AI and machine learning. Whereas in classic AI or an expert system, you would have someone with expertise in a task come up with a complex set of rules to get a computer to have intelligent behavior. Like, for example, you program in a computer heuristics about how to play chess, and you give the computer chess search algorithms, and you could achieve intelligent behavior through that methodology. And that contrasts with the machine learning approach, which is that you have the computer analyze a very large data set, learn from that on its own, and then be able to do whatever the task is based on what it has learned, rather than what an expert has programmed it with. So that shows a sort of a distinction between an expert system, which is a type of AI, and a machine learning AI.
You just mentioned a very large database system, mm-hmm. But before that you said that you feed about a decade's worth of data into your system before the system comes up with its market transaction suggestions. Is a decade worth of data sufficient, and how does it compare to somebody like, for example, Charlie Munger or Warren Buffett kind of investor who have like 50 or 60 years worth of experience?
Well, there's this trade-off that occurs. If you use lots and lots of data, the data becomes less relevant. For example, it's not clear that what happened in the markets 25 years ago really pertains that much to the markets today. On the other hand, you could use less data and have it be more relevant, So there's a fundamental trade-off. We use actually over a decade, but we don't use 25 years of data. So there's a balance to be struck.
I understand. And again, my next question pertains to your computer named Star. Just feel free to share with us however much you think it is possible in terms of what does the name stand for, how smart it is, and how is it different and or similar to, for example, Watson? Sure.
So Star is the nickname for our main trading strategy, our artificial intelligence-based trading strategy. It's based on machine learning, as I mentioned. So it differs from Watson, which was IBM's basically program that plays Jeopardy, in that it's not trying to understand human language. So Watson was really designed from the ground up to play Jeopardy, and in particular, that involves solving really difficult language parsing tasks, trying to understand what someone's actually referring to when they use different words. Our system is really about analyzing data that has to do with the stock market. So it's a fundamentally different task. Both of them fall under what you would call narrow AI, which is AI that's designed to solve really a particular problem. So Watson, they're trying to expand it to get it to do some other tasks, but those other tasks are still related to parsing sentences in order to try to map words to concepts. So it's still quite related, even though it's not Jeopardy. What makes them similar is that they both are using machine learning. They're both based on having a learning algorithm analyze large data set and learn from that data set.
So presumably, another 4 years down the road, your system would be even smarter than today.
Well, the hope is that our system continues to learn so that every day it knows a little bit more than it did the day before.
And would you say that kind of a learning, is it linear or is it exponential?
I would not say that kind of learning is exponential. It's more that it's learning. So in our case, it's learning more about the way the markets work or what factors impact a company's performance. I think when you start talking about exponential learning, we're talking about things like learning how to improve yourself. And then you can, once you've made those improvements yourself, you can then use those improvements to learn more about how to improve yourself. That could be an exponential process.
I see. And let me ask you this then. The limitations of Watson, as seen by Jeopardy, are usually not hard facts, but usually idioms, sort of a unique structures, linguistic structures that are usually learned only through experience and cannot be easily deduced or is there an equivalent of that in investing in the sense of the black swan factor, something that cannot be predicted based on the market data, a totally unique event, and is your machine better or worse equipped to handle events and occurrences like that than humans, in your opinion?
It's an interesting question. So when you talk about events that are unpredictable, the so-called black swan events, I mean, those are going to take everyone by surprise by definition, whether it's a machine or a human. And so I think that as far as I know, the best way one can deal with that is you try to design a system that's going to be robust to many different environments. That involves traditional portfolio management things such as don't use too much leverage in your system, don't rely too much on your risk model because your risk model might go haywire in a really crazy time period. Make sure that you stay diversified. Make sure that your bets that you're making are not too correlated with each other, or are unlikely to become highly correlated even in a strange environment. So you can think about all these different ways to try and make your system safer. And some of these things a computer does have an edge at in that you're able to sort of enforce in a very rigorous way many of these constraints, whereas when you have human investors, it can be hard for human to sort of understand maybe the correlations between 50 different assets. So that it can be hard for them to get an intuitive grasp of that in order to do portfolio management. In some ways, it's easier to do it algorithmically.
But how about the human factors? I mean, let's face it, most of the decisions taken on the market today are still made by people. So you can invest based on strategies connected to the sort of economics behind a certain decision, or you can invest based on the emotional motivation that other actors who are also investing with you would make. So, do you not think that a human investor would be better equipped to predict the emotional motivations of other investors, and therefore game the market better than a machine, which is entirely logical?
Well, it's interesting because what you're asking is whether a human can simultaneously understand the cognitive biases and errors of other people and not fall for them himself. Which is a challenge, and I think that there are some people that can do that. In fact, if you look at value investors, one of the mantras is value investing is to buy when others are selling. Of course, that's just not always a good thing to do, but the basic idea is that when other people are afraid, they'll tend to make mistakes. They'll tend to, out of fear, sell things for bad prices or for prices that are bad for them, and then you may be able to actually profit off of that. Human investors do that. But at the same time, if these biases are systematic, if there are certain errors that humans make reliably, which I believe there are, a computer might be able to pick up on that or might be able to infer such a pattern from data.
And what would be the benchmarks do you have any kind of a Turing type of an investment test to measure your system's performance in terms of benchmarks as opposed to a human investor?
Well, what you tend to do with quantitative investment strategies is you simulate them in historical markets, get an idea of how this would have performed at different periods of time. Of course, if something would not have performed well in historical markets, you shouldn't really rely on it to perform well in future markets. Although, of course, even if it does perform well in historical markets, it's not a 100% guarantee it will perform well in the future.
I see. So, what is the motivation and the ultimate goal behind your work? Is it to make money, or is it to create the smarter machine learning algorithms and smarter artificial intelligence eventually? Both of those?
Well, I mean, our firm as an entity is focused on trying to provide good investments for our clients, and that's what we set about to do. From my own standpoint, I'm really interested in intellectual challenges and trying to think hard about difficult problems, and in particular apply mathematics, apply machine learning to solving those problems. And I think that the stock markets are one such problem.
Fantastic. Let me move a little bit more into the questions related to your own self, because you have a very interesting background. So let me ask you, first of all, in your own words, who is Spencer Greenberg? Are you an investment manager, an entrepreneur, a mathematician, an AI researcher, a geek, a tea connoisseur?
Well, I mean, I do work in investment management, so obviously that label applies to me. However, I guess I would think of myself, before thinking of myself as an investment manager, I would think of myself as a mathematician, because that says a lot more about the way I think about the world. But even more so than that, I view mathematics as just one form of very systematic thought, which relies primarily on deductive thinking. And I think that more generally than that, I'm interested in thinking properly, which implies not just using mathematics, but also using the scientific method, using induction effectively, so there are lots of techniques for figuring out how the world works, understanding the world, making predictions, and I'm interested in many of those.